The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Market sentiment eases, but the repositioning, it remains aggressive. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Grafeo. We're here in the last hour of the trading day. Let's take a look at what markets are doing. Not so much on the index level, the S&P 500, just a bit in the green, but it is set to close out the week in the red. An outperformer here, semiconductors, the SOX index here. After a better outlook from TSMC, those chip stocks are outperforming. The Russell 2000 also in the green here. It's 11th straight day of outperformance against the S&P 500. And then finally, yields across the Treasury curve moving up a little bit, pointing out the policy-sensitive 2-year here after those doubts that maybe we're not going to see that Fed chair that most traders expected. Romaine?
Yeah, taking a look at that screen, particularly the first and third lines, the outperformance of the Russell really shaping up to be the main story for 2026. The Russell 2000 on an 8% bender right now to start the year, more than 6 percentage points higher than for the S&P 500. That's a differential of magnitude witnessed only 5 other times since 1979. And while historical trends favor further outperformance, note this, the complexion of the small cap rotation does suggest this is less about economic conditions and maybe more so about the closing of that earnings gap with its large cap peers, overlaid with conviction for rate cuts in the second half.
I've noticed small caps seem to be behaving a little bit differently than they have in the past. It used to be you kind of needed a strong pro-cyclical economy for small caps to rally. They've been behaving pretty well on days where we've seen some economic weakness. So I think they're behaving in a little more rate-sensitive fashion than they have in the past.
Fitting to be sure, but while economic and corporate fundamentals aided that rotation, this shift, it's still at the mercy of policy from Washington. You have a credit card rate cap that might kick in next week, a forced emergency power grid auction as soon as this month, and the can getting kicked down the road on legislation meant to bring clarity to crypto regulation. And don't even get me started on Fed independence and the impact on market positioning. So it's really no wonder that despite all the pie in the sky year-end targets for the S&P 500, the gains anticipated for large caps, they would actually just barely be in line with historical averages and well below the 16%, 23%, and 24% annual gains, Emily, that we saw for the S&P 500 the last 3 years.
That's right, Romaine. We typically don't see a 4th year in a row of a positive gain on the S&P 500. You look at the chart here, it's a lot of 3s and then a down year. But analysts on Wall Street are expecting a 9.2% rise in the S&P 500 for 2026. That's about what the average S&P 500 has been over the last few decades. And of course, we know the Wall Street forecasters are historically bullish. But of course, you can see on the chart here, that would be a lot less than what Wall Street traders have been used to for the last 3 years. And it kind of makes sense when you think about what Andrew Slimmon is saying. He says we're in the late stages of the bull market. So not the end of the bull market, but the late stages. So a 9.2% gain in the S&P 500 would make more sense with that kind of estimate, Romaine.
Well, let's go right to Andrew Slimmon, almost 40 years on Wall Street, senior portfolio manager and head of applied equity advisors team over at Morgan Stanley Investment Management. And Andrew, when I look at maybe some of the tempered expectations for gains on the S&P, overlaid with some of the big gains we've seen so far in the Russell 2000 and some of these cyclical sectors, is this kind of telling us we are kind of late stage in this cycle?
I mean, I do, just for the chart that Emily showed, which is it's the 4th year. I mean, I don't know how you can say it's early cycle if we're into the 4th year and we've, the market's up 100% off the low. How can you say it's early cycle? But I don't, I think the reason why small caps are rallying, Romaine, is small caps are anticipating that we have not only monetary policy stimulus coming through lower rates, but we also have fiscal policy stimulus. I'm amazed, Romaine, how little is discussed about these tax refunds that are about to start next month. We're all consumed with credit card caps and so forth. But I think that's what the market is queuing off of, is a real potential for GDP acceleration in 2026. And that's what causes a broadening out, right? Who needs to own just a few large cap stocks? You can go to a lot more stocks, including small caps.
Give me a sense, though, Andrew, and I'm glad you bring that up because there are a lot of provisions from policies enacted last year that really have not kicked in just yet. Right. And we are anticipating that. Of course, the tax refund issue is a big component of that. But give me a sense as to why you don't think the market has actually priced some of that potential upside in.
Well, I think, maybe it has in the mega cap mega cap stocks, but clearly the differential as you move down the cap curve widens. And so if you tell me that smaller companies are going to do better than they have in the past, it leads me to believe you're going to have a performance narrowing, and that'll be good. And that's what we're seeing. It's not just small caps, it's moving down the S&Ps. Size has not worked this year, and I think that's not a commentary on weakness amongst the mega cap. I think they're going to report very good quarters. I just think it's more of a confidence that this recovery in the economy is broadening out. I mean, at the end of the day, my important statistic, Romaine, is if you took out from GDP the spending, CapEx spending by the mega cap, the economy barely grew this last year. So I think, the year-over-year comps for a lot of companies is going to be pretty easy.
I wanted to ask more about just what happens with the Mag 7 if we do see this rotation. We've seen 11 straight days now of the S&P 500 underperforming the Russell. Is it a time to be selling tech necessarily or not?
Well, I mean, I think one of the benefits that I also feel comforted is I spent a lot of time talking to companies and listening to conference calls. And, what I heard out of TSMC the other night was business is booming. And so I think it's dangerous, Emily, right now to run out and say, it's over for these big companies, because I think they are going to report good numbers. And if, in fact, they've underperformed for 11 days, I would be a little hesitant to sell them here, because their earnings reports might remind people they're not, they're not over just yet. And I think that's what TSMC, started to tell us the other night.
Right. Talk about the consumer a little bit, because consumer sentiment has been very pessimistic. And why do you see that kind of turn higher as almost a contrarian signal for stocks?
Emily, it is. If you look at the University of Michigan Consumer Sentiment Index and you look at how the market does the next 12 months, when it's low, the market does well, and when it's very high, the market does poorly. And it's because the stock market focuses on the second derivative, which is the rate of change. And if it's low, it can go up. And if it's high, there's only one way to go, is lower. So I think the point is sentiment is poor right now. But if you get this stimulus for the consumer coming and you get lower rates, which should help the housing industry, I think there's a chance that consumer sentiment could lift. And I wonder whether this broadening out of the market, small caps doing better, is reflecting that.
Andrew, I do have to just get your thoughts in general on kind of the political and geopolitical risk out there. And I know it's always hard to quantify what that risk could actually be on corporate fundamentals and economic conditions, because it is basically unknown. But when do you start to maybe try to plot out more scenarios where some of those risks do become market events?
Well, yeah, I mean, you've nailed the risk for the market. Is if you look at the history of a stock market cycle during a presidential term, the second year tends to be the weakest with the biggest drawdown. And the reason is a very simple reason, is because in an effort to get Congress to win the party of the presidency, the presidents tend to roll out more populist agenda items. And that sends shockwaves through the stock market, like the credit card cap we've just seen. So I think that's the risk, is that could there be agenda items that the stock market doesn't like? I think that's where, kind of Washington, D.C. gets involved in the market. Now, the however is we do have a president, we certainly learned this last year after a big drawdown, that does get watches the stock market as a litmus test of popularity. So
yeah.
You saw a pivot, but it was certainly after a very big drawdown. I think that's important to consider, but that's the point, is that populist kind of rhetoric doesn't sit well with Wall Street.
All right, Andrew, always a pleasure talking to you. Andrew Slimmon, Senior Portfolio Manager over at Morgan Stanley Investment Management, kicking us off to the close here on this Friday afternoon with a focus on Wall Street and a focus on Washington, the intersection of which encapsulated by former FDIC Chair Sheila Bair. She stops by to discuss the state of the banking system, the broader economy, and her thoughts here on the drama between Trump and Jay Powell.
And speaking of the banking system, the big banks are done and dusted with quarterly results, leaving room for Netflix to take center stage. We'll break down expectations with Laura Martin, Senior Entertainment Internet Analyst at Needham & Company.
And as the earnings season shifts into second year and those conference calls pick up, a lot of questions going to be posed to CEOs about what exactly is going on in the world. A conversation with AlixPartners CEO Simon Freakley and this latest disruption index that his firm puts out and why some of those CEOs think disruption is here to stay. All that and more coming up in a bit. This is The Close on Bloomberg.
It isn't a matter of force. They want to develop a data center, so they've got to do whatever conditions are required to get permits and to be able to build a data center. But I would say that our relationships and negotiations with them have been extremely productive. They understand the need that we need to stop rising electricity prices on Americans. They get it.
U.S. Energy Secretary Chris Wright speaking to Bloomberg just a little earlier today about the power grid crisis and, well, some potential solutions being proposed by the Trump administration. Now, we also had a chance to catch up with the governor of Pennsylvania, where some of these proposals would have a direct impact. Here are his thoughts on who should lead the grid operator that controls that grid out there.
Someone who's responsive to consumers, someone who understands the challenges PJM is putting on the states, someone who can just move quickly. As we've been able to show in Pennsylvania by reforming our process, permitting process, we move quickly now. We need PJM to move as quickly as we are.
And we are expecting to hear a little bit more from PJM and some of the other grid operators a little bit later today. This is a developing story, and we will be all over it here as we move closer to the closing bells. Joining us right now is Andrew Weisel. He is an analyst over at Scotiabank to talk a little bit more here about the potential changes. And Andrew, first let's kind of put some context in this. Because of all the data center and tech build out that we've seen in a lot of communities, we've seen wholesale prices go up, at least based on the auctions, including the auctions at PJM, which is primarily dominant here in the Northeast, that they have conducted. There have been a lot of concerns about that. The proposal that's on the table right now by the Trump administration seems to suggest they want to go revisit some of those past auctions and potentially either cap rates or at least create dual tracks for what, say, a data center would pay relative to what a household would pay? Is that what's happening?
Yeah, there's a lot of possibilities. First of all, thank you for having me. It's definitely an important topic here. Affordability is a nationwide issue. It's electricity along with everything else, but electric bills recently have been rising more than a lot of other household items. And it's something we all deal with. Everyone has an electric bill, no matter who you are, no matter where you are. Data centers have become topical for everyone, and they are one of the biggest drivers of why electric rates are going up so much. It's not the only factor, let's be clear. You also have increased electrification of everything. You have more domestic manufacturing, and you have supply chain challenges, you have inflation, you have tariffs, et cetera. But for sure, data centers are the biggest single driver of those higher bills.
See, give me a sense.
PJM is the biggest grid.
Yeah.
And you're seeing a lot of upward pressure there.
Yeah.
A lot of states are very sensitive to it. So they do want to make some changes. The question is what? This is a proposal. It's not final, but certainly people want to take action.
Well, I am curious as to who you think is going to be affected by this most if we do see maybe a little bit of curtailment. I mean, we should just remind folks, PJM is under no obligation to take those higher costs and pass them on to consumers. Of course, that would erode their own profitability. But when you look at the independent power producers out there, who stands potentially to be affected most?
To be clear, PJM is not, they don't have profitability. PJM is a grid operator. They're not necessarily making money. The power producers make money, the utilities make money, but at the end of the day, PJM is a grid operator. The governors don't have a seat at the table. Any changes would need to be met by a negotiated settlement. The president and the governors are trying to implement these changes, but they can't do it unilaterally. There are a lot of steps that would have to happen for any changes to be implemented. Your question, who stands to benefit here or lose? right now, the independent power producers do get a lot of their revenues from the capacity auction and from everyday energy prices. Quite simply, adding supply to the grid, both in terms of capacity and energy, would put downward pressure on those future prices.
Can you talk a little bit about what kind of role the tech companies, particularly the ones that are creating a lot of this need for power to power their artificial intelligence programs, what role do they play in kind of this whole deal here? Because this is tech companies that would have to fund these new power plants.
Well, first of all, I want to give the tech companies a lot of credit. They've been very proactive about wanting to pay their fair share. They don't want to pay more than their fair share, but they want to pay their fair share. They want to do the right thing. And they've kind of said that from day one. So in a lot of non-PJM states, they're being clear about take or pay commitments, tariffs that protect the rest of the customer base, et cetera. What this new proposal in PJM to me looks and feels like is a lot of those other tariffs meant to isolate the impact of data center demand to protect the rest of the customer base. So in a lot of ways, this is about separating that demand class from everybody else. It may or may not cause downward pressure on everybody else's rates, but the important thing is it should limit future upward pressure to protect everybody else.
Is there any sort of potential that we could see a more uniform, federally negotiated solution to this? Or is this going to have to be state by state, region by region, as we're seeing now?
We've never really had a national energy policy. A lot of other countries do. That's been a big challenge in the US. We've never really seen it. We've seen efforts, we've seen pieces of a federal energy policy, but ultimately in the US, electricity is regulated by state commissions. They're generally appointed by governors. In some states, they're elected. Federal efforts have been there. Presidents have tried. Who knows what's going to happen, but I don't expect to see any nationwide law or policy. I think ultimately the states are going to be the ones to control it. PJM is a collection of states working together. It's been successful in some ways. It's been really unsuccessful in other ways. I do expect that we'll see some bigger changes than a lot of investors expect to the PJM construct. It might mean, at a minimum, an extension of the cap that we saw the last two auctions. A more meaningful changes might mean states allowing a separate auction like this one. Yeah. Even more extreme, regulated utilities in those states might be allowed to spend on some generation, like solar or storage. In a real extreme, some states might choose to leave PJM. We might see single states ISOs like we have in New York and California. Yeah. That's extreme. I don't think that's going to happen this year or next year, but it's an election year. Yeah. So the June auction for PJM, if that clears at a high price, it's going to be a really noisy election cycle like we saw last fall.
All right, Andrew, I have to leave it there. Great stuff, really smart. Andrew Weisel, analyst over at Scotiabank, keeping an eye on the utility providers with Vistra, one of the biggest decliners on the day, down about 8% as we still await more news here on exactly what this new policy will look like. We'll be back in a moment. This is Bloomberg. Keep an eye on shares of Netflix, down for a third straight day and a third straight week. They report earnings after the bell on Tuesday. Expectations high for the bottom line, but even greater expectations for clarity on that bid for Warner Brothers Discovery. Joining us right now is Brian White, Global Head of Internet and Software Equity Research at Monness, Crespi, Hardt and Company. All right, let's start off with the numbers first. What are we looking at in terms of growth?
Yeah, 17% growth. That'll be consistent with the third quarter. And, you know, Netflix has done okay on the top line, but there really wasn't much upside last year. Yeah. The first couple quarters, modest upside, and then third quarter they missed, and the stock tanked.
Well, this gets to this idea, too, as to where growth comes for a company that is relatively mature. It's basically king of the hill, at least in terms of the streaming space. And they're going after Warner Brothers Discovery. At the time, it looked like that could have been a clean deal. But now we've got this weird bidding war. And I just raises the question as to what do they need out of WBD, if at all?
I mean, I don't think they need anything. I think this is a defensive play. I think they saw companies like Apple, Amazon, and obviously Paramount looking at this, and they said, you know, we got to do something. Because for them, this is so outside the scope of who they are and their North Star. They don't need it.
So we have to ask you about whether, obviously the earnings are coming next week. Is Wall Street really going to care about what the earnings are for Netflix, considering that the stock, as you've written, has been really driven by all of this volatility and the bidding war that's not closing anytime soon?
I think it'll be irrelevant. It could move like a slight in the morning, one way or the other, but at the end of the day, the dark cloud on this stock in 2026 is Warner Brothers.
And yet, Bloomberg reporting they might do an all-cash bid. What does that just say about the strength of Netflix, particularly heading into the earnings report?
Yeah, I think this will eventually turn into a massive bidding war. And so there were reports that, Paramount might increase their bid. So where does this go? Just remember, David Ellison, Larry Ellison, Oracle, and PeopleSoft in 2004.
Yeah.
That hostile takeover that was, wrecked Silicon Valley.
Yes. We all remember it. Yeah.
We could be in for something like that.
Yeah, and of course, there's a lot of political dynamics given how close Larry Ellison is to the president and whether Ted Sarandos and Peter really want to sort of get involved in that. But it gets to this idea, as the company sort of tries to build on the success, obviously had a lot of success last year, not just with Stranger Things and the scripted stuff, but they're pushing the live events, which I think they're expanding even further this year with some of the agreements they have. Can that actually be a catalyst for greater subscription growth, even though we don't see the subscription numbers, and greater profitability?
I think engagement in the fourth quarter will be solid. Some of these new, like live sports is great and fine. But the issue that I have, I think there's a lot of video slop on Netflix. Mm-hmm. That's why I said, in my view, the highest quality right now is Apple TV. Apple TV doesn't have the depth of content.
No.
That's why this could have been a killer acquisition for them.
Yeah.
And so this is great. They add all this stuff. I'm sorry, I don't want to pay for WWE. Right? And so when they add all this content, what they want to do, they come back and say, hey, you know what? It's an extra couple bucks. They are a serial price hiker. Right?
Yeah.
And so is Spotify. It's the same thing.
Yeah.
Right? And adding content that no one wants to watch, I'm not paying more for that. It's ridiculous.
Yeah. All right, we got to leave it there. And I should point out, a lot of people watch the slop. Someone in my household that shall remain nameless. Brian, always great to catch up with you. I'm sure we'll catch up with you again next week. Brian White is the global head of internet and software equity research over at Monness Crespi. A preview of those Netflix earnings, which come out next Tuesday. Meanwhile, here on this Friday, Sheila Bair, former FDIC chair, joins us next.
I actually want to keep you where you are, if you want to know the truth. Kevin Hassett is so good. I'm saying, wait a minute. If I move them, these Fed guys, certainly the one we have now, they don't talk much. I would lose you. It's a serious concern to me. So I just want to say thank you very much. You've done incredible. We don't want to lose him, Susie. But we'll see how it all works out.
That's a great way to find out that you didn't get the job that maybe you just wanted. Live from Studio 2 here at Bloomberg headquarters in New York. It's 3:30 p.m. This is the countdown to the close. I'm Romaine Bostic.
And I'm Emily Griffeo. That was President Trump earlier today talking about, it seems a little like Apprentice, right?
Yeah, and who knows? No one really knows what the heck's in Trump's head, who he's going to pick. But the idea that a lot of folks in this market thought that Kevin Hassett would be an appropriate pick for Fed chair. And then the Trump, I don't know if he was being serious or not. Always hard to tell, but saying that, hey, I saw him on TV today. He was great. So I don't want him to be Fed chair. I want him out on TV, singing my praises. So
this was something that did seem to move Treasury markets just a little bit, though. We do have the 2-year up 3 basis points as traders kind of pare back. Maybe we're not going to see as many rate cuts this year as they expected if this is not the person that's going to be leading the Fed.
Yeah, and this is a big parlor game going on from Washington to Wall Street. And our next guest, who sits at the intersection of both, says the Trump administration has clearly made a, quote, strategic error with regards to its handling of the Fed. Joining us right now is Sheila Bair. She helmed the FDIC during the financial crisis and is now a senior fellow at the Center for Financial Stability. She's also got a great book out on financial planning for our youth called How to Not Lose $1 Million. And I love this book only because, Sheila, I was just at a book party with somebody whose title was How to, Make Your Next $1 Billion. So a nice counterpoint to that. I won't pitch you two against each other, but I do want to get your thoughts and pick your brain in all seriousness about this issue, not just of Fed independence in the most esoteric sense, but just this idea of letting government agencies do the job that they, to a certain extent, have been, obligated to do either by the Constitution or Congress in some way or another, and whether we actually are seeing a complete erosion of that we might not actually be able to get back.
Yeah. Well, I think we're definitely more broadly seeing an erosion of independent agencies' independence. But when the Supreme Court has supported that erosion and increasing authorities by the president to fire people who are otherwise term protected and where the statute says they can only be fired for cause. But they have carefully carved out the Fed as unique and in a need of independence and have a long tradition of independence. So I do think the Supreme Court may draw a line in terms of protecting Fed independence, even though for the other agencies, I think it's going, if not gone.
Well, I am curious. I mean, you were at the FDIC for several years, and you were at the FDIC particularly during a very contentious time for our economy. And so you were no stranger to criticism from lawmakers and the public. So I am curious about the state of these institutions today, Sheila, and whether you think they are sound enough to, if not prevent the next financial crisis, certainly to respond to it in an appropriate way.
Yeah, no, I do worry about that. I mean, there's been a lot of drama. The emphasis is definitely, around job layoffs, DOGE cutbacks, all of that. That seems to be the emphasis, plus deregulation as opposed to safety and soundness and bank supervision. That's not to say some of the regulations were perfect or could have been simplified. That's definitely true. But the trend really has been to deregulate, not to simplify. And yeah, I think it's been a distraction. And, we don't want to relive 2008. We need an agency, especially my old agency, the FDIC, to be prepared to handle significant bank failures to make sure those depositors are protected. If depositors lose confidence in the FDIC, we've really got a problem.
Well, let's stay on banks here. We did get big bank earnings this week that were fairly positive across the board. When you look at the outlook for the banking system, where do you see potential vulnerabilities?
Yeah. Well, whenever I look at how strong and healthy and bank earnings are good, I remember that was all true prior to the financial crisis. It was clearly, and then everything fell apart. So this may be the higher markets go, the harder they fall when it happens, and things just seem kind of bubbly to me right now. Mr. Trump clearly wants to run the economy hot. We're going to have credit stimulus. We've got fiscal stimulus. We're going to have monetary stimulus. He wants to cut credit card rates, deficit spending as far as the eye can see, deregulation. We're going to lower rates at the Fed. Whoever's in charge, that's probably going to be the trend. So I do fear that with markets already bubbly, that we're putting a lot of fuel on it, and how long, that works until it doesn't. So, and you do get complacent, when profits are good, bank failures are low, defaults are low, you get complacent. Oh, the good times are here, they're going to last forever, and they never do.
And of course, another theme that we're seeing a lot of people talk about on Wall Street is the K-shaped economy. You have the big banks doing really well, and then you have consumers really feeling stretched at the lower income side. People talk about housing affordability affecting a lot of Americans. Do you think any policy changes coming out of the current administration are actually going to move the needle on affordability?
Yeah, well, I'm glad he's starting to focus more on it. I think with housing, though, he seems singularly focused on getting interest rate down, which is going to just boost demand, which is going to make inflation worse because you have a housing supply problem. So I really wish he would focus singularly on supply. There's $200 million in MBS purchases that they're going to have the GSEs do. That is really ill-advised. I mean, that's like using the GSEs to do quantitative easing. And as we all recall, the MBS purchases by the Fed, there's like $1.3 trillion, I think, during the pandemic. That was kind of disastrous because it brought interest rates down, but it ignited, very high housing inflation. And most of the beneficiaries of those low rates were people refinancing. It wasn't people trying to buy a house. Home prices just kept getting farther out of their reach. So that juicing demand, getting rates down by whatever means, and certainly doing MBS purchases at GSEs, it's a risk for them too. They were doing this prior to the crisis. That's the reason they failed. They had these massive investment portfolios that included a lot of subprime securitizations. They did not know how to handle those risks. They did not know how to manage those risks. They had insufficient capital to absorb the volatility and the losses. The GSEs now are still undercapitalized. So to have them take on all this new risk on their balance sheet to try to get interest rates down, which is not their job, is really, puts them at peril again. And we can't risk I hope we don't see them getting into trouble again. So those are the wrong ways. We need to, he's a real estate investor. Build, baby, build. I mean, that's what we need to do. We need to build houses, and it seems like he's uniquely qualified for that. And it's frustrating there isn't a bigger focus, though he has been strong-arming the builders right now. So maybe we'll see some progress.
I am curious, though, on the point of the banks, and particularly the GSEs, and this idea that since the financial crisis, largely because of a lot of policies that arose out of that, including under the Obama administration, this idea that a lot of the risk in our markets moved into the private capital space writ large, and that's a very umbrella statement. But I am curious as to whether regulators have enough of a view into really what's going on behind the scenes in a way that they certainly had prior to the financial crisis, given so much of the risk was on the balance sheet of publicly traded banks.
Yeah. Well, that's true, though I would add that in the lead up to the crisis, most of those subprime mortgages were being made by non-bank mortgage lenders. Now, they were being securitized by the big Wall Street banks, but the originations were being by the non-banks, the so-called shadow banks. So there was some of that going on. And then the banks themselves were purposely keeping a lot of stuff off balance sheet in special investment vehicles. Remember those SIVs? They imploded and came back on the balance sheets when things started going bad. So it was a problem then, but it's a much worse problem now. You're absolutely right. And there's been so much hand-wringing about this in both Democrat and Republican administrations, but nobody really does anything about it. And in point of fact, a lot of the fuel that has driven the growth of the shadow banks, all these private funds in particular, it's bank lending. The banks are lending to them, and then they're lending to companies, as opposed to the banks lending to the companies directly. And that's basically a capital arbitrage, because the banks have a lower risk weight on their capital if they lend to the private fund versus if they just lend to the company directly. And then a lot of those companies probably shouldn't be getting credit, right? You don't want everybody to get credit. That's this, we're going to expand access to credit. Those are dangerous words I've heard so many times. Yeah. Some companies just shouldn't get credit. They're tenuous, they're risky. They shouldn't be getting credit. And so, just blindly saying, we're going to tolerate all this shadow banking and these shadowy structures to expand credit is kind of a dangerous mindset.
All right, Sheila, we can keep going on here, but they're telling me we have to go. Always appreciate talking to you. Sheila Bair.
Good chatting. Yep.
Former FDIC chair. We'll be back in a moment. This is Bloomberg. It's Friday. Well, more importantly, it's Factor Friday. Chris Cain of Bloomberg Intelligence joins us right now to talk about some of the big factors that have been leading this market. And Chris, we've been talking really for the last few days about this outperformance that we've seen among small cap stocks. I am curious, though, is this a value play? I mean, when we look at it from a factor perspective, is it value stocks kind of leading the way?
Don't look now, Romaine, but value has basically woken up over the last 2.5 months. I mean, especially in large caps, actually. Value hasn't worked great in small caps, but in large caps, we have the cheapest quintile of the index, meaning the Bloomberg 500, outpacing the most expensive quintile by about 13% since just the beginning of November. So that's a pretty large, long, short move in just 2.5 months. So, value has finally woken up. I will remind everyone that value as a factor remains very cheap. So meaning cheap stocks are way cheaper than expensive stocks compared to history. I won't bore you with all the numbers, but it's about less than 11% the price to sales when you compare those two. That's a 10th percentile relative ratio going back to 2000. So it's cheap. It has the momentum on its side, and potentially it could be set up for a decent run here.
And Chris, you wrote about an interesting twist on the traditional momentum factor that has done well recently. Just in the last minute here, tell us what it is.
Yeah, Emily, I don't have a great explanation as to why this is true, but so taking a step back, momentum generally was the best performing factor in 2025 when you look at the traditional factors, but a little twist on that did even better. So what we did was we looked at the percent a stock was above its 52-week low. So your long stocks that are way above their 52-week low, and you're short the ones that are closest to its 52-week low. That long-short factor is up over 35% over the last year. That's compared to about 13% for just more traditional momentum. You can even go back all the way to 2003, and that little twist on momentum has done a lot better. So, I don't really have an explanation as to why that's true, but, the performance kind of jumps off the page.
Chris Cain of Bloomberg Intelligence. Next week, you'll have that explanation. Thank you so much. Coming up, we take you to the closing bell with Jeff Blazek, multi-asset co-chief investment officer, and Neuberger Berman. This is the close on Bloomberg.
Welcome back to the close. 10 minutes until we get to those bells on a soft day and what's turning out to be a soft week. I'm Romaine Bostick.
And I'm Emily Griffeo. Let's take a look at markets as we close out the day. The S&P 500 actually just turning into red territory here, but, well, call it unch, but it's about to finish the week in the red after a green week last week. You can see the outperformance here of the Philadelphia Semiconductor Index, those chip stocks rallying today after TSMC yesterday boosted their outlook. And then another outperformer here, just by slightly, the Russell 2000 Index, those small caps lifting ahead of the pack. It's the 11th straight day of outperformance for the small cap index. Finally, looking at yields, Treasury yields across the curve were higher today, but the policy sensitive 2-year yield was up about 3 basis points as traders start to maybe pare back the amount of policy easing that we will get this year if we don't have Hassett as that Fed chair pick.
Yeah, kind of interesting, particularly on the 2 and the 10-year. One of the biggest moves higher on a points basis for those yields that we've seen in quite some time here. Maybe belies some of the bets in the markets here for maybe downward pressure on rates because of monetary policy. Jeff Blazek joins us right now here in Studio 2, multi-asset co-chief investment officer at Neuberger Berman. Jeff, great to see you here.
It's great to be here.
Let's talk about the potential tailwinds for this market and, more importantly, the headwinds that maybe could neutralize that. Are we kind of in a bull cycle? I don't mean that in the traditional sense, but the idea we came into this year, coming off of 3 phenomenal years, most people are looking at history and saying this can't repeat itself a 4th time, but we got this phenomenal rally in small caps to start the year. But in the past, I looked historically, the last time we've seen these type of outsized moves in small caps, they all came during years where effectively we ended up in recession.
Well, we do think we're in the bull cycle, and we look at it as a ledger of the positives and the negatives, and the positives overwhelmingly dominate the negatives. We do constantly ask the question, what could throw this off kilter? And the 3 risks I would call out fairly quickly is employment, but yet again, we had great unemployment claims data last week, so that appears not to be a huge threat imminently. The second one would be the credit markets. Spreads are tight, so maybe something goes wrong there that could cause a little bit of de-risking. The third would probably be the AI super cycle funding and whether some of the players start to run out of cash, frankly. But outside that, strong earnings and GDP growth, and it's full speed ahead in our view.
We do want to get to the AI and the data center stuff, but before that, I'm curious about your second point there on where we see credit spreads, which are just like, you can't even like fit a nickel between that spread right now. Is that a bet or a conviction on, I guess, the positive fundamentals for a lot of those borrowers and, for that matter, economic conditions?
The fundamentals are validated at this moment because you look at gross debt to EBITDA and a lot of other measures, and at high quality across the board. We're going to watch the distortions that we're going to see in terms of the investment grade benchmarks because mega cap tech is issuing far more debt than they have in many, many years. And so investors are going to have to decide for a fairly paltry spread if they want to be assuming AI-like risk in an asymmetry where, as a credit holder, your win is you get the bonds maturing, your lose could be downgrades and defaults.
Let's talk about AI because you are in charge of multi-asset here. And of course, a lot of people for a couple years have been investing in AI-linked equities. But I'm wondering if you're looking at other opportunities across asset classes. You talk about credit, a lot of these IG names funding data centers, some maybe more junk-rated companies are starting to issue debt that goes towards data center financing. Is this an area that you like right now?
We do, but what I would say is our overarching way we're playing this theme is the equity still. That's where you get the highest payoff, and we're playing the infrastructure build-out. So we've been heavily overweight Korea and Japan and China and the components makers, chips makers, because that's going to be validated for a couple more years to come. We do like the data center side, and you can pick your spot in the spectrum of either equity or debt or some points in between. And by the way, another dimension you can add to this is you can do it in the public markets. We also increasingly find attractive opportunities in the private markets to be an LP with a GP that's really picking the right spots where you can express better bets when it comes to AI.
I'm interested as more parts of the world of finance start to touch this theme, though. Does it introduce some risk here that all of Wall Street is all concentrated, public markets, private markets, all concentrated on this idea that this AI bet has to pay off?
It will. And when you do the math, there will be about 3 or 4 trillion of new capital expenditures deployed in the next few years. The stakes are really high. And when you figure out what type of sustainable revenue model will justify that return, we're talking hundreds and hundreds of billions of new incremental, whether it's coming from consumer or commercial, new fees that have to be paid for these services. And I don't think it's realistic to think that the hundreds of players that are making aggressive bets in this area are all going to be the winners. It's probably going to be a streamlined, small handful of companies that will be able to claim the superior returns, which may bode poorly for the other players.
But is that kind of what we're seeing, at least in public equity markets right now? Because there's been a lot of talk about the selling pressure we've seen on the big cap names, the idea that a lot of those names, including NVIDIA, haven't had a record high in 2 or 3 months. Yeah. But it's not like the money's necessarily coming out of the market. I mean, you see a lot of second tier players, for lack of a better phrase, in the AI and tech space getting pretty strong bids.
Yeah, it's a rotation that's really been interesting to us. So first of all, value is technically outperforming growth. Your point around NVIDIA would highlight that. Smaller cap stocks are winning, and industrials. So those that are actually involved more directly in the build out. But it's not to say that any tech is not winning. Like Korea is up 15% this month. China has been an outperformer. The emerging market equity has really been the main beneficiary of AI. And we should always remember this is not a U.S.-only story. There's going to be other countries.
Does that then expand? Because we talk about the outperformance of U.S. small caps relative to large caps. We kind of ignore the fact that last year the rest of the world as a group outperformed the U.S. And to start the year in 2026, that's also the same. Is there enough to invest in, though? I mean, I guess I can maybe understand Korea and some of the Asian nations. Europe?
Yeah, Europe, and we are at target on Europe after an overweight last year, and it worked out for kind of the wrong reasons. The multiples expanded, and the currency weakness of the dollar led to that outperformance, but the earnings were disappointing. So we've taken a pause on Europe, in part because, as you're saying, it's not as well tethered to AI, and earnings expectations are still for a 12% gain this year. We're in a kind of a show-me mode, we'd say, on Europe at this point.
Are you anticipating the dollar to remain weak to support some of those gains we saw?
At the margin, we don't think the dollar is going to fall as precipitously as it did last year, but it's still overvalued when we look at a lot of different measures. We do think the dollar will probably be down a few percentage points this year.
All right, Jeff, always great to talk to you. Jeff Blazek is multi-asset co-chief investment officer at Neuberger Berman, counting us down to the closing bells. Emily here with just about 2.5 minutes to go here. Looks like we're going to close in the red for most of the major indices, with maybe the exception of the Russell 2000.
Yeah, it's really been a historic streak for those small caps. 11 straight days of outperformance. What was interesting is you see that weakness in the NASDAQ 100, S&P 500, but semiconductors really outperforming today. The stocks was up like 1%.
Semiconductors getting a strong bid, and specifically the semiconductor equipment makers. So an interesting rotation there. A full breakdown starts now with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Emily Grafeo, taking you through to that closing bell with the global simulcast. It starts now. Carol Massar and Tim Stenovic join us in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. On a decidedly soft day in a decidedly soft week, but Carol, think about where we were on Monday. I know you weren't here, but hitting record highs, and it looked like for the large caps, and it looked like that was going to be
Don't steal my thunder.
The lead.
I know.
Should I just stop now?
Yes. Because I've been thinking about you a lot with the move up that we've seen.
It's the Sudafed, Carol.
I'm in your head.
That's why she's been thinking about you.
Get out. No, small caps, right? I'm looking at what we are seeing, about a 2% gain for the week overall. You look at the S&P 500, not even close. It's down about 1/3 of 1%. We still have a few seconds to go, but look at that outperformance.
I've been obviously focused.
Is that what you wanted to say?
I would have said it a little differently.
Well,
sure.
you would have been much more
Romania.
eloquent.
Yeah. Tim?
I've been squarely focused on what's happening with Bitcoin this week because of that market structure bill, and surprised to see that it's not under more pressure as a result of questions about the future of this bill. Brian Armstrong over at Coinbase pulling his support. A lot of questions about the future of it, but still, Bitcoin's up close to, above $95,000 right now.
Yeah, it was kind of interesting, too. I mean, obviously, this is a bit of a negotiating tactic by Coinbase and Brian Armstrong, which, of course, had an outsized influence on the last presidential cycle with some of the donations that they rallied from the digital asset industry. That, of course, will be a big story going forward over the next few days. Just a reminder, next week, it's going to be a monster week here. We get several earnings. The president's in Davos, and we have a big Supreme Court opinion on the Fed governorship and quite a few other things, potential tariff ruling. All of this combining to keep the market maybe a bit in check here on this Friday afternoon. The Dow Jones Industrial Average is going to lose about 80 points, or 0.2%. The S&P 500 only losing about 5 points, but that's still going to be down less than 0.1% on the day. A similar move lower on a percentage basis for the NASDAQ Composite and the NASDAQ 100. But you have to talk about the Russell 2000 holding in the green once again, 11th straight session, outperforming the broader market. We have not seen that streak of outperformance by the Russell 2000 relative to the large caps since at least before I was born in the 1980s.
Wow.
I think the only person around who is
please.
not born yet is on your set.
Wait, that makes you, how old?
And it's not you, Romaine.
No.
Hey, I'm going to go back to the big caps just for a moment, because in today's trade, almost an even number of winners and losers, if I may say it that way. 227 names in the S&P 500 gaining in the Friday trade, Emily, 276 to the downside.
Yeah, and we take a look at the circle here. You only had 1, 2, 3, 4, 5 of the major S&P sectors, 5 of the 11 in the green today, and the outsized move was actually in real estate, a 1.2% move for that group higher. And we should just point out the second best gainer in that area was industrials, and that was only half of those gains. Tech not doing anything on the day, healthcare in the red.
All right, guys, let's get to some of the individual gainers, if I may, in today's session. Got to talk about semiconductors again, some outperformance there in the trade. ASML Holding, Morgan Stanley laying out its bullish case for why investors should buy the stock, saying in the most optimistic scenario, the stock has a 70% rally ahead as chip makers ramp up spending to meet soaring demand for artificial intelligence. So you saw ASML up about 2% in the trade. And I got to mention semiconductors. They continue to be on a tear. They, as a group overall, most names in that index higher. The Philadelphia Semiconductor Index up more than 1% in today's session. All right, let's go to AST Space Mobile. Shares soaring in today's session. You saw that one up about 14%, up 19% at its highs intraday. But again, outperformance there. The satellite internet company was given prime contract position for the U.S. Missile Defense Agency's SHIELD program, something the president has talked about. It is connected, of course, to his Golden Dome effort. Stock up about 60% year to date, 17%, of the float is short. But again, some outperformance. Want to mention a bio.
What is the Golden Dome?
Well,
what?
you know. Yeah.
I don't know.
To protect in terms of missiles coming in.
Oh.
And this idea of like fighting back.
He knows.
I must have been off.
He knows. He's just being
Why
Romaine.
do you do this to me? Okay. Moving along.
I think they cut your mic, Romaine.
Immunity Bio, ticker is IBRX. That one up, check it out, guys, up almost 40% in today's session. It's a $5.2 billion market cap company extending its advance for an 11th straight session. It's a record streak. Company giving efficacy results from a clinical cancer trial for patients with a type of cancer that affects the lymphatic system. So really some outperformance there based on that trial. And I got to talk a little bit about the power sector. Talking about it all day. I'm sure you guys have as well today. President Trump moving to make tech giants pay for surging power costs. Analysts have been trying to figure out the winners and losers in here. And GE Vernova was certainly one, maker of natural gas turbines. Analysts seeing this as one of the winners. And you saw GE Vernova up more than 6% in today's session. Now to the losers. What?
Oh, she said losers and pointed right at me.
No,
that's
not-
okay. I'm glad you ended with GE Vernova because that's exactly where I want to start. We saw some stocks move lower as a result of this move from the White House. Constellation Energy Group, look at this. At the bottom of the S&P 500, down 9.8%. Worst performer. We've been talking about this all day. That move that caused GE Vernova shares to move higher caused some of the large power generation companies to move lower. Supply and demand here. If more power is available, if there is more supply, then prices could drop and, these companies would not benefit as a result. But Josh Saul on our program earlier reminding us this type of thing years out. Infrastructure takes a very long time to be built in the U.S., but still, this is the immediate share reaction that we saw. Also, the Mosaic company shares falling today. This after the company reported a significant decline in North American fertilizer demand in the fourth quarter of 2025. Phosphate sales volume fell at about 1.3 million tons. Shares falling today by about 4.5%. And finally, looking at DraftKings and Flutter Entertainment, the publicly traded companies in the sports betting industry. DraftKings falling 8%, Flutter, the parent company of FanDuel, down 6.3% today. This after weekly data from the New York State Gaming Commission showed that the revenue from online sports gambling fell during the NFL's wild card weekend. It typically attracts more bettors to games. This decline comes at the same time the volume of sports wagers on competing prediction market platforms grows. You don't just bet on the new Fed share, Romaine.
Bet on the new Fed share.
On Polymarket.
Yeah, I don't do that.
You bet on NFL outcomes too, I
You're
guess.
betting on when Taylor's going to get. How many people Taylor invites to her wedding? Is that what you're betting on?
You bet on how many times Romaine is going to interrupt Carol.
Oh.
I have no idea what either one of you are talking about. Just root for the Bears this weekend.
Taylor
Swift. Okay, because you threw me off there. You're talking about a different
Emily,
Taylor.
thank you for being with it.
I was like, by the way.
The wedding of the year.
Yeah, the wedding of the year, yes. Thank you, T-Wigs. Yields. Can we get to yields here? They moved higher. And that is significant here because we talk about a market that overall seems to think that through the course of this year, yields will move lower, but at least for right now, moving higher on the day and on the week. Carol.
Oh, so where are we going?
We're going to college.
We're going to go to college. Well, maybe not so many people are going to be going to college. Great Bloomberg Big Take story that's on the terminal. And it's basically talking about what's going on in terms of the U.S. birth rate in the United States, leaving too many colleges with too few kids. And we've seen the birth rate plunge since the 1950s. We saw a little bit of a kick up during COVID or during the financial crisis, excuse me. But basically, we're seeing it shrink. And so you think about the implications. We've already seen a bunch of schools closing. And so this is going to be tough, certainly, on the educational sector.
Like what I like about this story is it's a completely different take on what a declining birth rate in this country means. This is all about higher education because oftentimes we talk about this in the context of, okay, what does it mean for Social Security in the future? What does it mean for the economic growth, especially with the decline in immigration in the U.S., which has filled this the fact that Americans aren't having as many kids in recent years as they had, a few generations ago. But there are serious implications, not just for those things, but also for the higher education industry. It's kind of like K-shaped. You have the really good schools harder and harder to get into, and then fewer people wanting to go to the schools that aren't necessarily at the highest end.
This is a great story. I got two nitpicks. One, I wanted them to analyze a little bit more as to whether we just had too many colleges, universities to begin with, which I think was a big part of the problem. Also, the idea that, there's a huge demographic of people opting not to go into colleges and universities and just go straight into the, wow. Sorry, Tim.
Oh. That's what happened. So.
Wow, they were like, we're done with you guys.
Was it something
Goodbye.
I said?
Going into the long weekend.
What happened there?
That. I don't know. That was cool.
Say goodbye, Carol.
Goodbye. Good night, Gracie, is basically what they say. All right, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. Guys, have a really, really good weekend. Emily and Romaine, of course, continuing there on the close on Bloomberg Television. Tim and I continuing on Bloomberg Business Week. Well, maybe Tim won't be back.
I'm here. I'm still here.
I don't know. We'll see you again, same time, same place on Tuesday.
Our coverage continues here on Bloomberg Television with a push ahead to a busy week for earnings, including out of Capital One and all the concerns about those credit card rate caps, and Netflix and all the concern, not about its earnings, but of course about that pending bid for Warner Brothers Discovery. Laura Martin joins us next, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Markets closed just about 10 minutes ago. A soft day on a soft week, but that divergence between small and large caps still intact. 11 straight sessions, the Russell 2000 has outperformed the broader markets. You have to go all the way back to at least the early 90s or late 80s to see a streak of that magnitude. Bitcoin in stasis here on the day, and silver taking a bit of a breather after another record run earlier in this week. For the individual gainers, keep an eye on GE Vernova having one of its best days since at least last July on the back of policy proposals proposals that may alter the electric grid industry here in the U.S. Meanwhile, Salesforce having its worst week since at least 2024. In fact, we saw a huge sell-off all week long. A lot of these software as services stocks. Fannie Mae under pressure as a lot of investors now starting to get fed up with the lack of movement on policy changes for that cohort. And Intel down about 3% on the day, but actually had a decent week here. Remember, we had some relatively, encouraging comments out of the president with regards to Intel CEO. And of course, that is the backdrop for the earnings that we're going to get out of that company a little bit later next week. And that is our top story, earnings season, and really all the hopes and fears that accompany it. Remember, we kicked off this week with mixed results from JP Morgan, Goldman Sachs, and a lot of the big banks, most of which largely sold off because of weak guidance, rising costs, and of course, the risk of government policy. And next week, we're going to get more. The regional banks and brokerages are out, but that aperture really does start to open up with the consumer sector and results from Procter & Gamble, with the energy sector and results out of Halliburton, the mining sector and results out of Freeport-McMoRan, and the media and tech sector out of Netflix. Let's go straight now to Laura Martin joining us here live, not in studio too, I should say, over at Needham & Company. And Laura, let's first start off with Netflix and the actual numbers themselves, the performance that we saw last quarter and what you expect them to report.
Right. So we're looking for revenue of $17 billion and adjusted EBITDA of $3 billion. Recall they no longer release subs or ARPU. So it's hard to we can't really follow those. And what that means is there's a lot higher stakes on them hitting their financial metrics.
So, of course, the elephant in the room, Laura, is, of course, going to be the bid for Warner Brothers Discovery. And a lot of questions here, not so much about whether they continue to fight this, assuming that Paramount Skydance continues to make a move, but also just the idea of whether they actually need this, whether they need those Warner Brothers Discovery assets to facilitate growth, or whether they could actually potentially continue to do this the way they've done it for the last few years, organically.
Right. And I think a worry is if they don't hit their numbers, there's going to be a worry that the senior management is distracted by sort of a hobby. Because I agree with you, I don't think they need Warner Brothers, but it is because it's they're in the middle of a hostile bid against Paramount. I just worry that nobody's minding the shop. So if they don't hit their numbers, since this fight for Warner Brothers is going to go on for at least a year because of regulatory issues, I think people are going to be really worried that that is what the P&L can't perform with all these people distracted at the top.
You know, I have to sort of reference one of our competitors, the New York Times. They had a great interview kind of with Ted Sarandos, basically saying all the critics they just kind of misunderstand what this company is, or at least what it's growing into. And I'm wondering if you can articulate, as someone who covers this company well, what exactly is Netflix becoming? Because we talk about the traditional scripted streaming series and movies that they're known for, this big push that they've made recently into live events, and of course now the expansion of this ad business. What exactly is this company?
So I think historically, if they don't buy Warner Brothers, let's say Paramount wins Warner Brothers in the end, then they just are a television company. That's all they are. They're a television company. They put everything on Netflix first. You know, they have to be basically bullied to put anything into the window that's called the theatrical window. If they buy Warner Brothers, they get into a lot of new businesses in addition to streaming, in which case their strategic position does shift to be much more of look a lot more like a traditional studio company, like a Sony or a Disney, in which case they're really not differentiated. They've got big studio lot facilities, which has a lot of real estate costs. They have a ton of people. Netflix's revenue per person today, before it buys Warner, is $2.7 million. Mm-hmm. Warner Brothers is $300,000. Yeah. So they just, it just really averages them down and makes them look much more like traditional old-fashioned studio if they actually are successful at buying Warner Brothers.
I am curious, though, also about this idea of how they can address shareholders. This was a stock that lagged last year, a stock that's already lagging at the start of this year, at least certainly once you put it against the backdrop of the broader tech and media space here. This is a company that doesn't pay a dividend, a company that has been pretty stingy on buybacks. Do you think we're going to maybe see a little bit more from the CFO and the accountant side of this business saying, let's find a way to reward shareholders?
Maybe. So the answer is, I think they're going to probably have to go to an all-cash deal, and they're going to use leverage to do that. And so I just think that they're so locked down on transferring value to the Warner Brothers shareholders. I don't think they're going to be focused on public shareholders in the near term. They've got their hands full focusing on new constituencies that aren't public shareholders.
All right, Laura, always great to catch up with you. Laura Martin, Senior Entertainment and Internet Analyst at Needham & Company. Reminder, Netflix earnings Tuesday after the closing bell. When we come back after the break, we're going to follow another big event unfolding this week that could spill over into next week, the president's calls for an emergency wholesale electricity auction. We're also going to take a look at his proposals for a credit card rate cap that he says needs to take effect by Monday or else. That's coming up next here on The Close. This is Bloomberg. President Trump calling for an emergency wholesale electricity auction. The president looking to tame surging utility bills that have largely been up because of that build out of data centers. A little bit earlier today, Bloomberg caught up with PJM Innovations. This, of course, is the largest regional transmission organization in the United States. And here's what they had to say. They said that they are reviewing some of the principles set forth by the White House and governors of several states and say that they will try to make a decision here about where to go next. But they also point out here that this is an issue that, of course, needs to be weighed by all of the stakeholders involved. Nicholas Amicucci joins us right now, head of power, utility, and clean energy equity research over at Evercore. All right, Nick, give me a sense here. I know there's a lot of details we don't know about what the president's proposing, but if we do revisit these auctions, is there a sense that we're going to get a lower rate overall, a capped rate overall, or is the idea to create just two parallel tracks where you have kind of the industrial data center folks being charged one thing and then households and businesses being charged another?
Hi, Roman. Yeah, thanks for having me. I think, honestly, it's more of the latter. I think we're going to end up, I think that's the avenue that they're looking to take and willing to take is kind of the two kind of sleeves, if you would. One for the industrial folk, one for more of your average ratepayer. And it really will be, the devil will be in the details on how and if you have to kind of categorize your generation asset as one or the other, and then where we go from there.
I'm curious, though, too, when we talk about the potential beneficiaries from this, and I'm talking about in terms of companies and publicly traded companies to be specific, the potential beneficiaries and the potential losers. I was just looking at the markets last couple of days, and the move higher you saw in names like GE Vernova, but then the moves lower you saw in names like Vistra. What shakes out there for some of those companies?
Yeah, sure. Well, I mean, GE Vernova is an obvious winner, just because you're going to be bringing more capacity, more generation capacity online. That's the intent here. Mm-hmm. I think we're of the mindset too. This sell-off on the IPPs in general today has been a little bit overblown. Just because when you think about it, right, this kind of addresses one issue if you're thinking about supply-demand imbalance, but it's important to kind of take it in context because we ran into, at the most recent BRA PJM auction, you had a 6.6 gigawatt shortfall just to reach the targeted reserve margin set by the PJM. And so if we take these numbers at face value based on what we know and what's been disclosed, it's roughly $2,500 per kilowatt of a green build cost. Mm-hmm. And so if you back that into kind of the $15 billion that was outlined by the president's initial proposal, that really only adds about 6 gigawatts of incremental capacity. So we think that, look, and importantly, those 6 gigawatts are going to take time to build. So when you think about that, if you're allocating 15-year PPAs towards the hyperscalers in order to get them to pay, to incentivize them to build these new generation assets, they're not going to be willing to wait 5 to 7 years for these new generation assets to be built. So where is that PPA? Where are those dollars being allocated? Inevitably, that seems like it would be going towards those IPPs, and so you would basically be building that incremental generation as kind of a backfill towards those current power demand.
All right, Nick, really smart stuff here. We have to catch up with you again soon, I'm sure. Nick Amicucci over at Evercore ISI. And just a reminder, we are still waiting for more details out of PJM as well as some of the governors here about the next steps going forward on this issue. Of course, this isn't the only policy proposal Trump has floated. He has also proposed capping credit card rates. Basically, the average rate on a credit card today is around 20% or so. He wants to cap that, at least temporarily, to 10%. That sent shares of a lot of financial stocks lower, including Capital One, American Express, and some of the other lenders out there. They are now facing a January 20th deadline to comply, at least based on what the president says. But our next guest says the cap, it might actually benefit networks and some of the buy now, pay later players. Dan Dolev is senior analyst of fintech equity research at Mizuho Securities USA, and he joins us here in Studio 2. Dan, great to see you. Happy New Year. I haven't seen you to start the new year. Is it going to be a happy new year for some of these names here? I mean, I know it sounds scary to say, okay, you're only going to be able to charge 10% and nothing more. Who knows if he follows through on this? But let's just say we do see some sort of agreement on this front here. Who wins, who loses?
So there's obviously a headline risk with everything where Trump is kind of the plays, right? And now he's playing in payments. But I think if you actually think through this, and this is kind of the research that we've done, a lost credit card transaction, if a lot of those people are actually being forced to use buy now, pay later, actually buy now, pay later gets settled in debit. And so one lost credit transaction gets translated into 4 debit transactions because it's like paying 4, paying 5. It's a net positive for Visa and MasterCard. And I think a lot of people don't understand the dynamics.
Can you, this is going to be a dumb question, but I think it's important for you to explain, because I've heard this argument. Why do the buy now, pay later? So they're still technically charging interest, and we do know there is carryover. Technically, if you hold for a short period of time, you might not really be paying much more than the actual price of the good that you bought. Why is that 10% or that percentage anyway not a factor in the buy now, pay later?
So it depends. There's 2 flavors at least, or at least 2 flavors of that buy now, pay later. There's the pay in 4, they don't charge interest. They actually get paid by the merchant. So the merchant is actually paying a merchant discount rate, and you as the consumer, it's say a $100 transaction, a firm of the world will pay the merchant $95, and then you will get 4 increments of $25, so no interest.
I gotcha. Okay, so that's interesting. So then this goes back, though, to the traditional card issuers, the Capital Ones, American Expresses of the world here. There's been talk that if this were implemented, the real loser in all this is going to be lower income or lower credit quality consumers. But the idea is that the higher credit quality consumers, they probably won't feel much effect. Does that make sense to you?
I would agree with that. There's about $1.2 trillion of credit card debt in the U.S. I would say about 50% is below 750 FICO, and another, let's say 50% in the 600s. Some of those, if this actually goes through, some of those might get, axed out of credit. But the high, the Amex Platinum users are just fine.
Yeah, they'll be okay. But this does get to the idea, too. And I mean, you've been covering just the broader sort of fintech, or this growth of what we now call fintech. And I'm curious of whether this continues to kind of upend the more traditional financial models of us, who have a certain age, who relied on traditional banking for our credit cards and checking accounts, et cetera, et cetera.
I think until the midterm.
Yeah.
For sure. After the midterms, I think we're fine. So it sounds to me like there's, look, I mean, you know what's interesting, Romain? It's like, I remember during the Durbin Amendment, back in like 2012, everybody was worried about the networks and the financial. It actually gave birth to this entire, debit ecosystem, right? Like the next-gen debit. It actually made the networks more valuable, not less. So I feel like sometimes there's unintended consequences, and I feel like a lot of huffing and puffing, that's what H1 26 is going to be. But by H2, we might be like, hey, we won't even remember. What happened in the first half.
All right, Dan, I think we have to leave it there. Always appreciate it, man.
Thanks, Romain.
Dan Dolev is senior analyst of fintech equity research at Mizuho Securities. And just a reminder, that's a self-imposed deadline by President Trump for January 20th to drop those rates, to cap those rates at 10% going forward for at least 1 year. And a reminder, the president will be at Davos next week to lay out some of those policy proposals in more detail. We will have full coverage with team surveillance on the ground in Switzerland starting next week. Meanwhile, our show here on The Close continues in New York. When we come back, we're going to talk about all the politics and geopolitics that are rankling markets, because guess what? It's rankling a lot of C-suite executives as well. AlixPartners Executive Chairman Simon Freakley is going to stop by the program. So too is McKinsey Global Institute Director Chris Bradley. They've both been covering this issue, and they both have 2 very distinct takes on where we go next. You don't want to miss that conversation. That's coming up here next on The Close, right here on Bloomberg. Canadian Prime Minister Mark Carney calling the start of a new world order. This after striking a deal with China on trade and energy. Now, that meeting, it marks the first visit to Beijing by a Canadian leader in 8 years, and it's significant for a lot of reasons. For those leaders, as well as for chief executives, there's been a lot of talk here about a new norm called disruption. At least that's according to new research out by AlixPartners. And pleased to say joining us right now is the executive chairman of AlixPartners, Simon Freakley. Great to see you, Simon.
Great to be here.
To say that we're in an age of disruption might be an understatement, particularly after what we saw last year. I don't know who was naive enough to think that 2026 might be a little calmer, but we're already off to a fast and furious start. And it gets to the idea that when you are advising these executives, talking to the executives, picking their brains here, do they feel any sort of sense of clarity or comfort to a better degree than maybe what they saw in 2025?
Well, this is the 7th year, Romain, we've done our disruption index.
Yeah.
3,200 executives, 11 of the world's biggest economies, 10 of the biggest industries. The world is as disrupted today as it's ever been in our study. But a couple of interesting insights. One is that CEOs seem to be thinking this is normal. They're getting better at managing in this multiple and intense disruption environment. But they are very anxious. They're anxious because the pace and the intensity is such that will they keep up? Will they be able to pivot quickly enough to adapt? And interestingly enough, about 15 to 17% of these companies, we call them growth leaders, are actually doing incredibly well in this environment. They're outperforming their markets and their competitors in revenue growth and earnings growth. So it's a time of opportunity as well as a time of challenge.
Well, I want to talk about both of that, the opportunity and challenge, but I want to stay on the challenge for just 1 second here. When they start to see headlines from, Trump saying, I want to cap credit card rates or I want to ban, investors from buying single-family homes, are you still seeing CEOs react to that immediately, or is it kind of like, okay, we don't know where this is going, let's just wait and see, get more details, and then we'll formulate a plan?
Well, the CEOs I speak to every day, what they've got really good at now is understanding there are going to be disruptions. They don't know exactly what they're going to be, but there will be more disruptions rolling out month in, month out. They've got much better at not reacting or overreacting to a particular single disruption. We're getting better at managing the complexity of them. They're planning for multiple outcomes. They're not being a hostage of one strategy. They're pivoting very quickly. They're leaning in. It's leadership by leaning in, really. They're being ruthless in their capital allocation. They're being ruthless in their prioritization. They're getting rid of non-core assets. They're prioritizing M&A where they think they'll make a difference. So they're getting much better at it, Romain.
Well, that gets to the idea of opportunity. And I remember, I don't know if maybe we can draw a parallel, but I remember during the COVID and all the big supply chain disruptions that we saw then. And companies were really shook by that. But it was also interesting to see how those companies updated their supply chains in a way that they probably would not have done and that they probably should have done years prior. And a lot of them came out of it much healthier, a much more efficient supply chain line. And I am curious as to whether the disruption we're seeing now on a slightly different front with geopolitics, that does end up being kind of the catalyst to improve these companies in a way that might not have happened.
Well, it turned out, of course, that COVID was a dry run, that people had these wonderful just-in-time supply chains, and they realized they didn't have a just-in-case supply chain. So they had to quickly pivot, not just to what they could get globally, but what regional supply chains would provide, what local supply chains would provide. So having got through COVID, when disruptions continued, and of course, tariffs became a real issue. They had done this once. They knew what the playbook was. It's interesting how quickly CEOs around the world have been able to digest tariffs, have repurposed manufacturing capabilities, shifted contracts to optimize in this new tariff environment. So I think, if there's another wave of tariffs, if there's another type of disruption that will impact supply chains, geopolitical developments, for instance, I think people are much more practiced at this now. They're better at it. They're expecting it.
I do have to ask you, the World Economic Forum is kicking off in a couple of days in Switzerland. The President of the United States is going to make a big presence there. He's given a keynote speech there on his economic policies. He's taken a huge delegation of advisors and cabinet leaders here. Is the presence of the United States going to be the dominant one at this conference?
Well, the US is the dominant economy, so of course they'll play a very important part in the discussion. But it's fantastic, I think, that the US is getting involved in the World Economic Forum or that global discussion in such a material way, because they're a very important player. But it's an impressive turnout, actually, of political leaders as well as business leaders this year, maybe even the best turnout ever. So I think there'll be rich discussions. I'm personally delighted that the US will be in the middle of it.
Well, I bring that up because, we know the US has been the focal point of the global economy, and for good reason. reason for decades. There's a lot of concern, or I shouldn't say concern, but there's a lot of people pontificating that might be shifting, a slow shift, but it is a tectonic shift. Yeah. So that maybe it not necessarily be one singular country, but we might have a more regional breakdown where maybe China rules the East, maybe the U.S. rules the West, and who knows what rules in between. But do you see a bit more of a split and divergence in the global economy, in the global structure?
Well, I think that, for the last 35 years, we've lived in this extraordinary global supercycle where the world has been largely flat. There's been little friction in the movement of goods or services or capital. And the world, through populist governments around the world, are reshaping the polarity of the world. Obviously, I get to see from the privilege of a front row seat with our clients every day how business leaders are dealing with this. And they're pivoting and trying to work out in global businesses or even international businesses how best to adapt to that. There's clearly a repositioning going on, and business leaders are trying their very best to read that and make the business decisions that leave their enterprises as best placed as possible.
What are you hearing in terms of the most optimism out there with regards to sort of what people are looking towards, what people think not just are going to drive their individual businesses, but really, the economy overall?
Well, in our survey, 3,200 executives around the world, I mean, the vast majority of executives are optimistic about AI. They're optimistic not just about the efficiency that AI can drive in their businesses, but also how it can drive revenue growth. So we touched on these growth leaders earlier. The majority of those growth leaders are really understanding how these tools and these capabilities can drive the performance of their business at the top line and the bottom line. So I think a large amount of optimism about AI, but a real sense of anxiety. They're not moving quickly enough to capitalize on those new capabilities.
Simon, always a pleasure.
Great to see you.
Simon Freakley is the executive chairman over at AlixPartners, and we should point out AlixPartners has a new report out here on their disruption index, I should say, for the 7th straight year. We want to continue in this conversation and talk about the world's economic engines and, more importantly, what keeps them humming. Now, our next guest has used 30 years of consulting giant McKinsey's research on economic abundance to inform his latest book. It's called A Century of Plenty. It's a story of progress for generations to come. And it has some interesting prescriptions here about where we go next and, well, examples here of what the world can follow. Pleased to say, joining us right now is Chris Bradley. He's McKinsey Global Institute Director and Senior Partner at McKinsey. Great to have you here, Chris. And just looking at your book, let me just start off. I'm a glass half empty kind of person. Your book was very optimistic. And I am curious as to why.
Well, that's the lesson of history. Is that the single truth that's characterized the last 100 years is almost unstoppable progress. And, progress happens nearly everywhere. In fact, in the last 100 years, average incomes around the world went up 6-fold, and we added 40 years to human life. So it really is the pattern of the last 100 years to see amazing progress. The question we ask in this book is, when our grandchildren and their children look back from 2100, will they see a plateau of humanity, or will they see another century of abundance?
Well, that's what I'm curious about, too, because I don't think anyone can argue we're way better off in 2026 than we were in 1926, probably even 1956. But, of course, we know that has not been linear in terms of the progress. There's been tremendous upheaval over that. Obviously, the Great Recession, 2 world wars, several other regional conflicts, and a lot of other stuff in between that we don't have time to mention here. It raises a question as to whether we're in one of those periods right now of pain, if you will, even if that does mean that when we get to the end of this, that pain ends up turning into some sort of new prosperity.
Well, we've been talking for a few years now that we're on the cusp of a new era. And in fact, I think we're in a new era. And it feels confusing, doesn't it? I can see why we're talking about things like uncertainty indexes and things like that. Our take's actually a little different. We think we're just in a new era, and the direction of travel is actually quite knowable. It feels noisy, but that's because we're tuned into the old network. We all grew up in a world which was an actually unusual period of history. We call it the era of markets, where you had globalization and unipolarity and digital technologies. Now we're dealing with multipolarity, we're dealing with humanized technologies, we're dealing with energy contention, all of these things. But the lesson of history is we go through these era changes all the time. It happens about every 30 or 40 years. And guess what? The story of humanity is one of continuing progress through it.
It's one thing to look at the aggregate numbers, whatever measure we want to use to look at progress and say that it's all up. I think one of the issues we've seen, certainly over the last decade or so, not just here in the U.S., but around the world, is this idea of inequality in those gains. The idea that, yeah, overall we're improving, but a lot of that improvement is being accrued to a small cohort of people. That's led to revolutions in other countries. It's led to some interesting political decisions here in the United States. And I do wonder how much of a factor you see in what's happening now and whether that arrests progress going forward.
Well, I mean, you started the segment by saying you're naturally a glass half empty person, but you're not alone. Most people are. And certainly the thing we had to confront in this book is kind of almost pervasive beliefs that growth's not possible, or growth's not good, or growth's not for me, it's for someone else. Actually, the world has never been more equal, if you look in aggregate today, than it's ever been. Sure, there's some nations where inequality goes up or down a little bit, but the general, for example, even in the US, the bottom quintile, if you take into account taxes and transfers and all those things, since 1980, their incomes have doubled. It doesn't always feel that way. So the book, we kind of try and write it from a place of empathy, of, hey, we know life can be tough, and we've got to bring everyone forward. And that's why for 2100, we imagine a world where every citizen on the planet can live a life that's as good as Switzerland is today. And that's an epically good life.
And you use Switzerland as kind of that benchmark. I think you referenced something like $82,000 in GDP per capita for that nation. When we talk about that standard, though, and what brings us there, talk about the role of technology. I mean, we've talked a lot about AI over the last few years. You either get, one extreme or the other. Either AI is going to kill us all or it's going to lead us to salvation. But we've seen technological progress before in past decades and centuries that ultimately have led to not just greater productivity for businesses, but greater comforts for its people. Do you see AI replicating some of that?
We're very bullish about the role of technology, and this is nothing new. If you go back to 1925, where we start our book, 15% of people worked in jobs that we call non-routine cognitive, like creative work. But now that's 45%. So what's happened as technologies have taken hold is that people have just moved on to do things that I'd say feel even more human. Now, why is it that AI gives us a particular sense of optimism? And that's because we've got a few challenges to get over. One of them is a demographic challenge. For example, take China. By 2050, there'll be half the number of under 25-year-olds in China. So we need automation technologies that can help people, that can help humanity. And we see AI as kind of a general purpose technology that can give a real shot in the arm to productivity. Because after all, if there's one lesson from our work, it's that productivity is the engine that makes wealth possible for everybody.
All right. Chris, got to leave it there. This is a really fascinating read, a nice compliment to some of the work that you've done in the past, a very optimistic look at our future. Chris Bradley, he's McKinsey Global Institute's director and senior partner there, and you see his new book there on the screen, A Century of Plenty. All right, a lot more coming up here on the program. We're going to talk sports, and we're going to talk MMA. The UFC has a big event coming up in about a week's time. And, of course, they have that big White House fight that they're planning for July 4th. I had a chance to catch up with the CEO of the UFC, Dana White, and he says it's not political.
George Bush was a big baseball fan, Obama was an NBA fan, and Trump is a UFC fan. Mm-hmm. I don't think that any of those guys being fans made any sport too political.
More of that conversation when we come back. This is Bloomberg. All right, we're going to talk the UFC. Paramount Skydance is already betting big on it. Dana White calling the $7 billion deal that it has with Paramount incredible for fans and the sport alike. The CEO of the UFC recently joined us to discuss how the partnership is changing the sport, and he also talked about his plans for that big fight on the White House lawn. Take a listen.
Now the pay-per-view's gone. I mean, what it would have cost you for one fight, it's less than that now for the year for Paramount. So that brings in, a much bigger fan base, and all the different shoulder programming that we can do with Paramount Plus and CBS. For instance, CBS already has our entire library. Paramount Plus already has our entire library up on their platform. So as soon as you click on, I watched Landman the new episode when it came out the other day. As soon as you click on to watch, UFC is the first thing you see.
Wow. So, but does this deal, is it going to change the compensation practices that you have for fighters? I mean, the pay-per-view model was a pretty straightforward model in terms of how you compensated the fighters. How does that change under a straight agreement with Paramount?
Mathematically, it can be figured out. And obviously, the new deal is incredible for the fans. It's incredible for the sport and the business. And it's definitely incredible for the fighters.
I mean, you've had overall. I mean, UFC has had a relationship with Paramount, CBS, that entire structure, and this new regime under David Ellison. I am curious going forward. You also have a pretty good relationship with the president, and I know that there were plans to do some sort of big fight on the White House lawn, potentially in commemoration of the anniversary, 250th anniversary of 1776. Is that still happening?
Yes. So we literally, my whole production and ops team was over there going through all the logistics.
Oh, yeah?
We got all that dialed in now. Heading into, this month we launch Zuffa Boxing and UFC on Paramount Plus. After that fight is over, we'll start focusing on what fights are going to be at the White House.
I mean, you think about your fights filling stadiums. I know that there's plenty of space on the White House lawn, but how are you factoring that into your planning when you think about just the sheer number of seats, for example, you can
There'll be
have?
5,000. Yeah,
Okay.
there'll be 5,000 seats. And then right across the street, the park, the Ellipse, that'll hold 85,000 people. We'll have screens over there, and people will be able to hang out. We're going to take over Washington, D.C. the week of the fight.
And my understanding is that, you've had dozens of fighters say that they want to participate in this event. So how are you evaluating who actually makes it on the roster, so to speak?
Yeah, I mean, just about everybody on the roster wants to fight on that card. It's a one-of-one special event. I mean, when will there ever be another fight or sporting event at the White House? So it's a history-making event, and we'll see how this year plays out with different fighters, and you want the biggest, the best, and you want the card to be great. You want it to be, we want that every Saturday, but we definitely want it for that card. So it's all about matchmaking, and we'll try to make the best fights we possibly can.
Obviously, you're known primarily for MMA, but you've got you mentioned the Zuffa boxing venture that is getting up and running this month. Talk a little bit more about how far along that is and whether you think it will be a viable competitor to some of the other straight boxing promotions.
Well, I don't want to say we'll be a viable competitor. We're going to blow them all out of the water is what we're going to do. We're in a good spot with that. That launches the 23rd. It'll be the day before the UFC fight. That will also be on Paramount Plus. And I mean, literally yesterday, before I flew here, that's all I worked on all day yesterday was boxing. So I'm excited about. I wouldn't be sitting here talking to you today if it wasn't for boxing. That's where I came from. I love the sport, and I've talked a lot of smack about boxing over the years. And now it's
that's
time.
what I'm curious about. Is there a future there? Because I felt like listening to you over the years, it sounded like MMA was the future and boxing was somehow withering away.
It was, and it is. And now I'm going to fix it.
Well, Dana, before we let you go, you mentioned you're a busy man. You got a lot going on. One of the things that you do have going on is that you're on Meta's board of directors. I believe it's just over a year now. So curious to hear how that's going.
So if you would have asked me a year ago if I wanted to be on a board, I'd have told you there's no way in hell. When I got this opportunity, I'm so big into social media. And now that I'm on this board, I mean, I'm blown away every time I go to a board. Mark Zuckerberg is a killer. This guy is a killer. And when you sit in these board meetings, it is impressive. Not just him and how he runs his business and how he runs these board meetings. Everybody on the board. Every time I go there, I would think that it would bore me and drive me crazy. I'm literally sitting like this the entire board meeting. It's one of the best decisions I ever made, and I love it.
Dana White, of course, the CEO and president of UFC. You can actually catch that full interview. Go to Bloomberg Markets, go to Bloomberg.com, type in the close, and you can see the full thing here. A very colorful interview here, of course, about the big fight night he's planning on the White House lawn for July 4th, his push into boxing, and, of course, his relationship with Mark Zuckerberg. Let's check in here on financial markets as we close out what has been an incredibly volatile week. Remember, we started the week with a massive surge in equity prices to record highs. And while the S&P and the NASDAQ and the Dow faded from those highs, the Russell 2000 kept chugging along. A 2% gain on the week, outperformance once again. In fact, it's been 11 straight sessions now where the Russell 2000, the small caps, have outperformed the large. We have not seen that type of outperformance since going back to the late 1980s. This is Bloomberg. As we close out a busy week, well, prepare yourself because next week's going to be even busier. Now, here in the U.S., it is a federal holiday in honor of Martin Luther King, so markets are closed, but the World Economic Forum is kicking off in Switzerland. We will have coverage of that starting on Monday right here on Bloomberg Television, and that will continue into Tuesday and beyond. Tuesday is going to be important because that is President Trump's self-imposed deadline for credit card companies to cap those interest rates at 10%. We're also scheduled to get earnings out of Netflix on Tuesday after the bell. We're going to hear from President Trump once again on Wednesday. This time he gives a keynote address at Davos, where we are expected to get some more details on some of his economic proposals. That speech also comes against the backdrop of the U.S. Supreme Court hearing arguments on whether the president has the power to fire a Fed governor. As we move to Thursday, we start to get more economic data, including the Fed's favored gauge on inflation, that PCE data. We're also going to get jobless claims, and we're going to get earnings out of Intel, Capital One, Alaska Air, and Alcoa. And we rounded out on Friday with a lot going on in the monetary policy space. ECB President Christine Lagarde scheduled to speak, and the Bank of Japan scheduled to make a rate decision. It's a lot going on. All of your coverage can be found right here on Bloomberg Television.